some of the largest listed healthcare companies in India are predominantly unbranded generic businesses as far as percentage of revenue and percentage of capital employed is concerned. These large cap healthcare companies in India currently trade at a range of 14 to 20 times trailing EV/EBITDA. However, some of the recent mergers and acquisitions that have happened in the unbranded space indicate that valuation multiples in the private markets tend to be in the range of 7 to 10 times EV/EBITDA, which is almost at a 50% discount of the trading multiples of the publicly listed companies. Hence, there is a disconnect when it comes to valuing these unbranded generic businesses between the private market and the public market, which is confusing investors. Which of the two markets are right? Our assessment on this is that there are two key factors that are leading to this disconnect. The first disconnect is that the listed unbranded pharma companies have an element of branded businesses also, which may be a lower part of the revenue and the profit or the capital employed, but it is still a part of their overall structure, and hence they trade at a slightly richer valuation. Second, the larger pharma companies offer more liquidity, and hence most of the institutions remain interested in those stocks, given these institutions have very large amounts of money to manage. Now, if you think about the first factor, which is essentially the conglomerate nature of the large pharma companies and the fact that they also have branded businesses to go along with these unbranded businesses, that is a fundamental argument. However, we feel that most of these pharma companies are actually using the cash flows of these branded businesses to keep investing in the unbranded business, which definitely should have an impact on their valuations, and valuations therefore should be ultimately closer to the unbranded generic valuation and not closer to branded generic valuations. The second factor, which is essentially the liquidity that these large pharma companies have to offer, that in our understanding is a more technical factor, and this factor will take care of itself as the market forces keep evolving depending on the macro and micro environment for investing. We at InCred Healthcare PMS are bearish on unbranded generic companies. We have only 9% weight in our model portfolio in unbranded generics, which is when compared to the index, which is 48% in the unbranded space. Now, ironically, the converse is true for branded generic companies. The branded generic healthcare companies in India trade in the range of 11 to 20 times trailing EBITDA. This is in the listed space. However, if you look at the recent M&A transactions in the space, that has happened in the range of 15 times to 33 times trailing EBITDA. Now again, this disconnect is confusing investors as to why the private valuations in the branded space tend to be higher than the public valuations of the branded space. Now here again there are two factors, similar factors. Factor one, the conglomerate nature of even the branded generic companies in India. Now the branded generic companies in India essentially are those companies for whom the branded business is a larger part of their revenue, their profit, their capital employed. But they still have some unbranded businesses. So the first factor therefore is that the branded generic companies still make money in branded generics, but they use some of this capital, not all of it, but some of this capital, this cash flow which is generated, to invest in the unbranded business, and therefore they deserve a discount to the private market multiples. But that discount need not be very high because they are not using the entire cash flow, they are using a very small fraction of the cash flow, and hence we argue that the valuation of the branded generic company should actually be closer to the branded generic private market valuations rather than the unbranded private market valuations. Similarly, the second factor here is the liquidity that these companies have to offer. Now, for instance, Torrent Pharma, say 5-6 years back, was a very small company with very limited liquidity, and many of the institutions couldn't buy it, so the stock was extremely cheap. But now that the company has become fairly large and it is a branded generic company, we can see valuations of Torrent Pharma being perhaps the highest PE multiples that you can see in the space today. And that is because now the institutions can also buy into the liquidity. So hence we feel that the fundamental argument that branded generic companies should trade cheaper than unbranded is actually not valid, because branded generic companies use a very small part of their cash flow to invest in unbranded. And the liquidity argument will take care of itself as branded generic companies scale up. We have seen this scale up happening in JB Pharma, we have seen this happening in Torrent Pharma, and we have seen the valuation multiples re-rate. So we expect such sort of re-rating in other branded generic companies also, as and when they gain scale, and the institutions are actually able to participate in those stocks given the liquidity stocks have to offer. We at InCred Healthcare PMS are extremely bullish on the branded generic space. We have a 42% weight in branded generics in our model portfolio. This is when compared to 16% in the BSE Healthcare Index, which is our benchmark. Thank you.